Know the meaning of foreign investments, understand the importance of foreign investment in India, learn about various types of foreign investments, identify the various investment restrictions on FII, explain the working of GDRs and ADRs, analyze the need of foreign investments in Indian context. Introduction. India is of the fastest ever growing developing countries in the world. And for sustaining its growth, it requires resources so as to meet its investment requirements. Domestic funds in the form of savings are insufficient to achieve its growth targets. Consequently, India needs foreign investments. Foreign investments can be either in the form of FII, more commonly known as Foreign Portfolio Investments, FPI, or in the form of Foreign Direct Investments, FDI. They means foreign investment help in meeting the resource gap so as to maintain the momentum of GDP growth rate, which in its own turn ensures the robustness of the economy. Foreign investments in India. Meaning of foreign investment. Foreign investment refers to investment made by residents of one country in another. For any country, it is an important source of inflow in the economy. But for developing country like India, it is even more important so as to keep the momentum in the growth of the economy. Researchers like Alfaro, Chanda, Sebnem, Oskan, Saik in their research paper named How Does Foreign Direct Investment Promote Economic Growth? Exploring the effects of financial markets on linkages under NVER working paper number 12522 have highlighted the importance and need of foreign investment in the economy. The paper talks about the increased growth rate in the economy due to inflow of funds in the economy. They say that the growth rate felt by the economies receiving is almost twice than that of those countries which have poor financial markets. Not only this, productivity is seen increasing by the countries receiving FDI than those which aren't. Lastly, local factors like structure of the market, human capital force also generate a positive impact on the growth rate of the economy. They lend a support to the already existing resources, thereby enabling it to work even better. Need for FI in India. As mentioned earlier, India is one of the fastest growing economies in the world, and to meet its investment needs, domestic funds alone are not sufficient. Foreign investments thus play an important role to act as a catalyst for its growth. Following are some of the points highlighting the need for foreign investment in India. FDI enables transfer of technology, knowledge, expertise, services, and capital. Promotion of competition among domestic players in the market. Foreign investment in the form of FDI helps in improving the human capital development, as FDI provides employment of more and more people and also includes training of these employees. Helps in maintaining momentum of GDP growth rate in the economy through capital formation. Helps in building foreign exchange reserves. Foreign investments also help in building up demand for the Indian rupee in the international market, which in turn helps in strengthening the value of Indian rupee in terms of other currencies. Helps in better use of existing resources like land, labor, capital, etc. Limitations of FI. Some of the prominent limitations of foreign investment are as under. One of the major concerns that need to be considered is outward remittances. FII and FDI come with the intention to earn returns which they remit back to their country through repatriation of profits. Remittances in outward direction affect BOP position of host country. Foreign investment in form of FDI leads to transfer of ownership and management as well as control. Involving foreign companies in industries that are of strategic importance can prove to be risky. Therefore, India has to come out of legislative ceilings on these investments. Too much foreign investment, more especially FPI, can lead to sudden economic shocks in the economy being further exacerbated. Components. Foreign investment can be obtained from broadly three sources. A. Foreign institutional investors, FII or FPI. B. Foreign direct investment, FDI. C. Global depository receipt / American depository receipt, in short GDR / ADR. Foreign institutional investors, foreign portfolio investments. FII is defined as an institution organized outside India for the purpose of making investments into the Indian securities market under the regulations prescribed by SEBI. FII comprises of overseas pension funds, mutual funds, investment trusts, asset management companies, nominee companies, banks, institutional portfolio managers, university funds, endowments, foundations, charitable trusts, charitable societies, a trustee or power of attorney holder incorporated or established outside India, proposing to make proprietary investments or investments on behalf of a broad-based fund. FIs can invest their own funds as well as invest on behalf of their overseas clients registered with SEBI. These client accounts that the FII manages are known as sub-accounts. A domestic portfolio manager can also register itself as an FII to manage the funds of sub-accounts originating from outside the country. Foreign institutional investors include entities established or incorporated outside India, which purpose to make investments in India. Optimistic report about the Indian economy along with fast-growing market has made India an attractive destination for foreign institutional investors during the last few years. Few examples of FII are HSBC, ADR, HSBC, Citigroups. Investment restriction on FII. There are certain restrictions which FIs have to abide by while investing in India. 1. They can invest maximum of 10% of the total share capital issued by the Indian company. 2. Total investment of FIs in any Indian company cannot exceed 24% of the total share capital issued, unless they seek further approval by board members and their shareholders. 3. FIs can register with SEBI as a debt fund or an equity fund. FIs which are registered as equity funds are required to invest at least 70% of their funds in equity and equity related securities. A FI registered as a debt fund, on the other hand, must invest 100% of its funds in debt instruments. Foreign corporations and individuals are not eligible sub-accounts of a FI that is registered as a debt fund. 4. FIs are not allowed to involve in short selling, but they are permitted to hedge by short selling their holdings so as to protect them from losses, other than in respect of derivative securities traded over a recognized exchange, and must effect transactions through a registered stockbroker. 5. Various limitations as well as restrictions imposed to FDI also apply to FII. They also have to abide by the pricing requirements which are applicable to FIIs. 6. FIs are not permitted to invest in print media as well as in atomic energy, lottery business, gambling and betting, business of chit fund, Nidhi company. SEBI has come up with new rules and regulation for FII. They can make foreign investment through financial instruments like participatory notes, through derivatives, and it needs to be binded up within 18 months. Not only this, SEBI has put regulation for imposing in FII through spot market, that is, P notes cannot be invested through spot market. Foreign direct investment. FDI refers to the investment done with the intention to gain some degree of control over the management and ownership of the company. It is a direct investment into production in a country located in another country, either by buying a company in the target country or by expanding operations of an existing business in that country. To qualify as FDI, at least 10% of the shares of the company must be acquired by other company. FDI, which is now allowed in various sectors of the economy, has seen continuous increase, which demonstrates increasing international investors' confidence in the Indian economy. Cumulative FDI flows into India since year 2000 until now are US dollars 3,45,073 and FDI inflows for the year 2014 are US dollar 21,511 million. Many countries are willing to invest in our country, which gives robustness to the business environment in India. So as to improve inflows further, GOI is taking various initiatives to relax FDI norms and make it investor friendly. Even the Prime Minister Mr. Narendra Modi has taken various initiatives to make our environment investment friendly in India so as to encourage the agenda of Make in India. The aim is to help India achieve higher GDP growth rates. ADR/GDR. FDI can also invest in the form of ADR and GDR. They are also instruments of foreign investments where Indian companies go directly to international investors in their respective countries by offering them Indian securities represented by ADRs or GDRs. GDRs. GDRs stand for Global Depository Receipt. They are issued in non-USA countries but largely denominated in US dollars. So, if an Indian company goes to other country other than USA to raise funds, they will issue shares. Shares will be kept with depository bank that will be converted to GDR and issued to non-USA country investors. Indian company will therefore get the much needed foreign investment and foreign investors can get benefit in the form of depository receipt issued to them which are traded like any other security. These holders of GDRs are entitled to all the benefits of holding the shares like dividend, right issue, bonus issue, etc. ADRs. ADR are instruments through which a US resident can invest in a non-USA company. For example, if Indian company goes to raise money from USA, then Indian company will issue shares which will be converted into ADRs by the respective depository. For example, JP Morgan Chase Bank is one of the many banks who act as depository bank for many US companies. This investment in ADRs or GDRs shall involve currency risk. This risk can be mitigated by taking a hedging position in the currency derivative market. American Depository Receipt or ADR are negotiable instruments issued by a US bank in lieu of a specified number of shares in a foreign, that is non-US country. ADRs are US dollar denominated. Working of GDRs and ADRs. Let's consider the case of ICICI Bank shares. They are listed in Indian Stock Exchange. A foreign investor wants to invest in ICICI script, they can do so with the help of ADRs and GDRs. ICICI has a depository receipt in New York, that is Deutsche Bank. Now, if ICICI comes out with ADR or GDR, they will have to submit equivalent number of shares with Deutsche Bank. For each depository receipt in circulation, Deutsche Bank holds the equivalent number of India listed shares on behalf of the owners of ADR. For example, if the ratio is 2:1, means for every 2 shares of ICICI, 1 ADR/GDR will be issued to its investor, then 10 millions of ICICI shares will be converted to 5 million ADRs/GDRs. The depository bank issuing ADR charge a fee for the holding onto the shares that back the ADR and doing all the paperwork, which usually varies between $0.01 to 0.03 per share per year. Rules and regulations to issue GDR, ADR. There are various rules and regulations pertaining to issue of GDRs, ADRs by Indian companies. They are permitted to raise money from the international market by issue of ADRs, GDRs. They can issue them without seeking prior consent from RBI if those companies are eligible to issue ADRs, GDRs in terms of scheme for issue of foreign currency convertible bonds and ordinary shares through Deposit Receipt Mechanism Scheme 1993 and subsequent guidelines issued by Ministry of Finance, Government of India. Not only this, after the issue of such instruments, such company had to file a return along with reporting quarterly as prescribed by the regulations. Generally, there are no end-use restrictions to use of ADR and GDR proceeds at the time of issue, but there is a complete ban on investment in real estate sector and in stock markets. Summary. According to a report of Working Group of Capital Markets Consultative Group on Foreign Direct Investment in Emerging Market Countries in 2003, a very interesting fact came to light. It was noted that foreign direct investment, while investing in emerging markets, focus on various factors. They search for market-seeking investments. They prefer to invest in countries where they can find a suitable and unexplored market having potential to grow and earn profits. And not market-seeking but also efficiency-seeking. They aim to tap those countries, those areas where they can tap the untapped efficiency in the economy. While investing in them, they also look for countries that participate in free trade agreements and also indulge in regional trade integration programs. This helps not only in increasing regional demand, but also helps in increasing the potential size of the market. This will not only increase investors' interest and will also add and attract productivity. The report also discusses the motivation and determinants of FDI. They find out that location of the investment, location of economic sectors, size of the market, growth prospects, labor cost and labor availability, etc. are few of the factors that are considered by the investor while investing in countries. Not only this, even the infrastructure is very important factor. It is crucial factor taken into account by countries. The report also highlights areas where international financial institutions can focus and pay attention in order to improve the environment to invest in emerging economies. The report suggests that investors should constantly regulate and monitor the investment climate. This will help them make more informed decisions. The report also highlights the determinants of FDI. They pay attention to factors like exchange rate. Importance is given to its stability. The more the stable exchange rate, the more appropriate it is. Low inflation is another factor that is focused upon. Last but not the least, sustained growth is another important factor considered while deciding whether to invest in an emerging economy or not. The more the favorable of these factors, the more favorable environment is created for FDI. For the sake of simplicity, author has divided all the major factors into two broader categories. First one being size of the market, growth opportunities, local labor cost, infrastructure facility availability, and the tax regime of the country. They help in creating economic and commercial interest. Author focuses on availability of such factors. He says availability of labor at a low cost not only affects the labor cost and overall total cost, but also affects the overall productivity. Not only labor, infrastructure is equally important. Availability of facilities like electricity, water, transportation, etc. are important factors influencing the decision to enter into a country or not through FDI. Other important factors are licensing system of the country, legal framework, etc. They help in understanding the institutional and regulatory system of the country. Legal system of the country has to be strong and stable enough to give hold on those who enter their market. Not only there should laws, but they should be strictly followed. Therefore, the above mentioned factors are very important for the successful entry of FDI in a country. Every country interested in their growth through FDI should give all the above mentioned factors equal importance.